everyone, welcome to ET Now Realty Reckoner. I'm Snehi Shah and today we're diving into the often perplexing world of real estate investment, a realm that can feel overwhelming, especially for first-time buyers, but it doesn't have to be. If you've ever thought about investing in land, apartments or even REITs but have felt uncertain about where to start, we've got you covered on this episode. We'll explore essential topics such as how to choose the right investment type, the steps involved in making a purchase and the common pitfalls to avoid along the way. And to talk more about this, joining me first on the show today is Mr. Sudhir Pai, CEO at Magicbricks, to help our viewers understand how to take that first step when investing in real estate, some essential do's and don'ts, and also how to gauge the correct real estate investment for you and much more. So let's get started with that conversation. Mr. Sudhir, thank you so much for joining me on the show. What would you say is the first step for someone looking to invest in real estate for the first time, and how do they go about the process of making a purchase?
You are likely to make what is going to be the most important or one of the most important financial decisions of your life. So it first pays to build conviction into why you're buying a house. Now, there are, of course, many reasons for wanting to buy a property. There's economic security. You might want to build a lifestyle around it. You might have an investment objective. But one must be able to answer the question for yourself on what is the reason why you're looking to buy a house and build a high degree of conviction behind it. Second step, determine your requirement. Now, there are 4 parameters that are essential to make a basic requirement. First, what can you afford? What's your budget? Second, which part of the city do you really want to live in? Third, how big a house do you want? And fourth, when do you want the house? Do you want something which is ready to move in, or can you wait for a few years while you get possession? Now, be mindful that these 4 parameters, one will have to make trade-offs. For example, if you want a big house, but you're constrained on budget, you might have to compromise a bit on distance. Or if you want a property which has the latest amenities, then you might have to wait a few years to get possession, right? So basis what, and if you don't know where to find information or how to decide on what your budget is or which part of the city to stay, there's a lot of help available online. Portals like us, for example, carry a lot of tools and calculators that can help you decide how much you can afford basis your income and basis what your current outstandings are. There are tools available which give you locality reviews, pros and cons of one locality versus another. There are distance calculators which can tell you the optimal distance between the point of interest that you have in mind versus the locality where you want to stay. So there's a lot of online help available that can help you research and get the answers to what your requirement is. Third, I think you should make a list of what are non-negotiables for yourself and what are good to haves.
Okay, well, point taken. Thanks so much for that, Mr. Pai, but also help our viewers understand that when it comes to choosing between different real estate assets, like so you have land plots, apartments, ready to move in apartments or under construction apartments, how should a new investor make that decision of which real estate investment is fit for him or her, and what are the pros and cons of each of these avenues?
If you're an investor and considering between should I buy a land, a plot, a house, or maybe an apartment, first of all, start by defining your investment objectives, right? So how much is the return you want? What is your time frame? And what is the amount of capital that you want to invest at this point of time? I think the second thing that you should pay attention to is how much is the time and your own capability from a point of view of the amount of effort you want to take in the process of buying the particular asset and exiting that property. Second, how much is the time and effort you want to put in overseeing the property and in taking care of its maintenance? Now, if you club these 2 things, which is what are your investment objectives versus the amount of effort and capability and resources you'll have to put in overseeing the entire asset, I think you will get most of your answers. For example, from a return perspective, assuming that everything else remains the same and you're bought correctly, plots are likely to give relatively better returns as compared to a house, which is likely to give you a marginally better return as compared to an apartment. But from the second point that I mentioned, buying a plot is likely to take more effort, unless, of course, you're buying from a very reputed developer in a gated community, But otherwise, it's going to take far more effort in terms of paperwork, you're doing legal checks. Most plots are outside the city, so the sheer amount of effort at going and evaluating the property is going to be far more. And you're going to face this both at the time of buying the plot as well as at the time of exit. Likewise, from a point of view of maintenance or overseeing the property, plots or independent houses are going to be far more, it's going to take a lot more effort as compared to the effort that an apartment is going to take. So if you're someone who doesn't want to put too much effort in the process of buying or exiting a property, and you don't want too much headache at maintenance or oversight of the property, probably buying from a good developer in a gated community could be a good answer.
Okay, well, point taken, but also help our viewers understand what are some common pitfalls that first-time real estate investors fall into usually, and how can they avoid them?
I think an important thing is not to fall for the first shiny new toy that comes in the process of buying a house, right? So real estate, by its very nature, it's a pretty glamorous industry. You're likely to come across very good-looking collaterals, even better experience centers, a lot of lovely advertising material. Not that there's anything wrong with it. In fact, any good developer or any good project is going to project itself very well. But I think you have to train your mind and yourself to be able to look beyond that and determine the real substance of the property that you're looking to buy. So that's, I think, rule number one, which is don't fall for the first shiny new toy that comes along. I think the second thing is don't fall for a herd mentality, particularly in today's market. Don't rush to buy a particular project or a property just because everybody else is buying it. It may not be right for you. Third, I think you have to plan for an exit, especially if you're an investor. Then, by definition, you're not going to stay invested forever. At some point, you'll seek to exit that particular property. Plan for that exit beforehand. A lot of investors don't plan for exit, and at the time of exit, they would then face difficulties. And last but not the least, pay careful attention to the fine print. Do check if there are any clauses that make exiting the property difficult for you, or if there are any fees or charges that you were not aware of, right? So do go through the fine print and make sure that things are okay for you. I think if you take care of these 3 or 4 elements, you should do quite okay.
Okay, now that we've understood how to buy, help us understand if it is possible to time this entire real estate market. How should a beginner analyze market trends to determine the right time to buy? Is there a right time to invest? And what are some key economic indicators to watch out for in real estate for someone who's looking to dip their toes in this real estate investment?
I think you shouldn't enter real estate with a very short term in mind.
Okay.
I mean, for example, the last 3 years have been excellent for real estate. But even so, even though the markets are looking very strong, we usually advise buyers don't take a short term view. So if it's a quick buck that one is seeking to make, then we'd usually advise people to stay away. Now, a lot of the work that Magicbricks has done has been to help a first-time buyer or a first-time investor go about making his decision through a data-driven method. Now, our framework usually has revolved on the following. Right now, if you look at the real estate markets, there's plenty of data available on how prices are moving and what the sales velocity looks like. Now, that's the output. But if you're going to deconstruct it into determining what drives price or what drives better sales, then the following factors is what one will need to look at. We usually look at demand-supply mismatches because a locality in which there is strong demand and limited supply is likely to see prices hardening. We look at yields. A project, a property, or a locality which has high yields is likely to do better from future price appreciation. We look at sentiment in the market, right? And these are some of the parameters which I think there is plenty of data available. There's a lot of research reports available. I think as a first-time buyer or investor, if you familiarize yourself with all of these parameters, you should be able to draw a pretty good assessment into which way the wind is blowing and take a smart data-driven decision for yourself.
Okay. But Mr. Pai, you did speak about yields, and that is something that I want to base my next question for you on. For someone considering investing in an apartment, how should they evaluate the rental yield that they're expecting? What's a good rental yield to aim for? And even if they're not taking it to rent, they're taking it to reside in that apartment, what's a good return rate that they should be expecting in the future when they make a sale, and overall just what would be an ideal, a good rental yield to aim for?
First of all, let's define what yield is. Yield is actually your annual rental less the maintenance costs divided by the current capital value of the property.
Okay.
For example, if you own an apartment which the market price is about 1 crore today, and if your monthly rental is 25,000 less the maintenance fees, your annual rental is going to be 3 lakh rupees. So 3 lakh rupees divided by 1 crore, your current rental yield becomes 3%. That's the way yield is computed. Now, why is yield important? Yield is important because it is a good indicator of what is the underlying genuine demand for houses in that particular pocket, right? So if you're not planning to stay yourself and you're planning to give it up for rent, then a yield is a good indicator of how much that property is in demand. Because if there are a lot of people seeking to take the property on rent, your yield is likely to be higher. If not, it's likely to be lower. Now, Indian markets have typically delivered a yield of about 2.5% to 3%. At this point of time, markets are on a much stronger wicket. There are cities where the yield is going all the way up to 4%. But generally, we would reckon that a yield of anything upwards of 2.5% is a good yield to have. Now, one should be worried if the yield of a property is lower than 1%, or maybe even lower than 1.5%, because then you should evaluate it a little more stringently to make sure that you're not buying a property where the prices are inflated or the particular market is not very frothy. So I think that's the way to look at yield. But please also bear in mind, yield is like the dividend returns of an equity scrip, right? So over the long term, if real estate is going to deliver a 10 or 11% return for you, then 7 to 8% of that return is going to come from capital gains, and maybe 2 to 3% is going to come out of the rental yields. So do bear in mind that while yield is important for the reasons that I just mentioned, the larger return is going to come from capital gains.
All right, Mr. Pai, thank you so much for joining us on the show on ET Now and explaining our viewers how they can get started with their real estate investment journey. On that note, we'll let you go. But with Hello there and welcome back to Realty Reckoner. Now that we have understood how to decide which property investment is the best for you, we now have Gulam Zia, Senior Executive Director at Knight Frank India, joining us to speak about how to go about carrying out this transaction of making an investment, financing options available, and also to demystify the smoke about the probably the hottest topic in the market right now, which is investing in REITs. So let's get started with that conversation. And Mr. Zia, thank you so much for joining us on the show. Help us understand what are some factors an investor must keep in mind before locking in on the property. Are there any online tools or platforms that you would recommend for first-time investors to research properties, track market trends, or manage their overall investments?
First of all, to start with, I would suggest a few very basic rules of investment in real estate. Number one is, please understand, real estate asset is very illiquid asset. When you're comparing with other asset classes like gold or even stocks or any other commodities, etc. First thing that all of us should always remember, if we are investing in real estate, it is for long term. It is not something which you can flip overnight like all the other asset classes. People have made mistakes of considering real estate as a flippable asset and have burned their fingers. So number one is that. Number two is you have to also understand that real estate is cyclical. Many of them always want to believe that this is an asset class where the prices will continue to grow and grow and grow forever, which is not the fact. So we need to be very cautious while buying real estate, especially housing. And that's what I would want to believe more than 80-85% of our investors who are actually buying real estate as an asset class buy houses. And for them, it's very important to understand under construction apartments are not very, very good investments to start with if you're not looking into the credibility of the developer. While the most profitable venture of all these, or the profitable asset class or sub-asset class of all of them, is land, because the appreciation of land value is the highest. On the other side, office as an asset class also gives you a recurring income. So if you are actually looking at a long-term investment during which you would have some recurring income, annuity also coming to you, then you should look at office or a shop, because the rate of return there is far better than going for house. The rate of return, annual rate of return, when you're buying a house would be around 3% per annum, whereas for a shop or for an office, it could be 7 to 9%, depending upon what kind of a property it is, where it is located, what kind of demand supply situation. Of course, on the other side, you also have options which have just about started, like a REIT. In fact, even prior to REIT, I would say you could also look at buying shares or stocks of listed real estate entities.
All right, Mr. Zia, you've spoken about REITs, and that's a topic that we will discuss a little later on this show, but also help us understand once an investor has decided to purchase land or property based on what's fit for him or her. Also help our viewers, take our viewers through what comes next in this process. What is the paperwork, the stamp duty cost, some important documents to have handy. Give our viewers some tips to have on hand while making an investment like this.
You have to ask for the local property tax or anything that has to be pending on that property. You should ask for the receipts. You should also ask for the receipts of utilities like electricity bill or water bill and so on and so forth. Then also, when the transaction is happening, there are two kinds of transaction costs. One, that you're paying to the authorities, which is to the local municipalities, etc., which will happen through stamp duties and so on. On the other side, you have to also pay some transaction cost within the society or condominium. That would be decided by the bylaws of those societies or condominiums. You need to read that very carefully. It's extremely important for you to register the document. The moment you do the transaction, ideally, immediately you should go for registration, because the longer you delay, the longer of the chances are of some problem creeping up in your title documents. Now, one more thing that you need to keep in mind is, in many states, there is a discount for female buyers. So if a lady is buying a house, typically there is some concession on the stamp duty that you may also want to make use of. So a lot of those nuances that you should be aware of. So when you are looking at getting it tenanted or hiring someone, letting someone hire that property, take it on leave-in license, you need to also be aware of the different kinds of transactions you can do. Leave-in license is the safest bet, because it gives least of the right to the occupier on your property. Taking it on lease or long lease, etc., are very risky, both from the stamp duty perspective, the transaction cost perspective, as well as the rights perspective. So it is the best if you give only on leave-in license on a defined period, typically 11, 22 or 33. Typically 33 months is what is assumed to be safe bet if you're giving it on leave-in license. Even when you have given it on leave-in license, you have to be very cautious that before the period is over, either you get the property vacated, or if at all you want to extend with a contract, do that before this existing contract is over.
All right, Mr. Zia, also help us understand what kind of financing options are available for first-time investors.
Well, if it is financing, you should also keep in mind that the housing finance, HFCs, give it only on buying the houses or even shops. But then, of course, the rate of interest is something which you have to be wary about. Fixed rate of interest or variable rate of interest, these are two different situations. You need to fully understand what is better for you. Please seek the advice of your chartered accountant, somebody who understands the finance better, to get you to advise on what you should do when you're raising a home finance. But HFC is something which is the easiest, because the rates are also varying, but at the moment, while they're very high, but as we believe in times to come, with the Reserve Bank of India most likely bringing the interest rates down, then home loan interest rates will gradually start coming down. The best home loan interest rates I have seen in my career of more than 3 decades was about 6.25% of interest rate, which was about 3 years back. Post-COVID, we had the lowest of the home loan interest rate available. It is now gradually, it has increased because of inflationary trends, and RBI has brought these corrections. But going forward, we see it peaking out and gradually coming down. So if you are a buyer, you want to take a home loan, right now is the right time, because going forward, your EMIs will shrink as the home loan interest rates start coming down. either your EMIs will shrink or your a number of EMIs remaining will shrink. So this is something which again you have to tie up with your bank and understand how it works out. But please understand, when you're buying a land, home loans are not available. So that is when you have to really seek raising loan or raising capital on some other property. Like for example, if you're buying a land somewhere, you may want to, if your existing house is not already mortgaged or has a loan on it, you may want to take a loan against property on your home and then pay for the land that you're buying. But please understand, you cannot take debt on buying a property on a land.
Okay.
Rest of it, a finished good or a finished property, whether it is a shop or a home, you can take a loan against it.
All right, well, let's finally address the hot topic, and the topic that's perhaps got all real estate investors very interested and hooked onto. And what I'm talking about is REITs, because that is what the rage is about in the market right now. Help us understand what a REIT is, how it works, what is the process of investing in one, and is it recommended for a first-time investor who is unsure of where to park his money in the real estate space? Would you recommend parking money in a REIT?
REIT, the real estate investment trusts, have come up as a new opportunity for investing in real estate. REIT is an opportunity where a trust comes in, run by professionals who get these income generating assets on their portfolio and give you these assets as a trade, stock in trade. So you have all these REITs are then listed on the stock exchange. So you can buy the shares in these REITs like the way you can buy share in any other commodity or any other organization or a company which is listed on the stock exchanges. Similarly, REITs are also listed. So you can buy shares of those REITs, and those REITs give you dividends. And these dividends are directly out of the money that they collect out of rentals. Now, the returns on the REIT may be lesser than what you would find otherwise if you are buying a shop or an office and renting it yourself. The returns will be better compared to REIT, because obviously, please understand, REITs are run by professionals. So there will be a fee that they will also charge to take this whole proposition for you. So REITs are very, very liquid. So here, the problem of liquidity is also off your shoulder. So this is REIT as such is a better proposition to invest. However, currently, there are barely a couple of REITs in the market. 4 or 5 or odd of these REITs are there.
All right, well, that brings us to the end of today's episode of Realty Reckoner. Viewers, we hope the insights shared today have given you a clear path towards your first real estate investment, whether you're eyeing land, apartments, or even REITs. A huge thank you to both our guests for joining us, Mr. Sudhir Pai as well as Mr. Gulam Zia, for their expert advice and valuable perspectives. And thank you to our viewers for tuning in. Until next time, stay informed, invest wisely, and we'll see you soon.
If you like this video, then like, share and subscribe to ET Now.